When the CFO, the CEO, and in fact the COO all buy shares, it's time to take note. And we are talking in literally just the last few days, so this is very fresh data. And Peter Lynch in fact says when insiders buy, it is one of the most bullish signals in the market because management only buys shares when they believe the stock price will in fact go higher. Now in this case, these insiders have been topping up around 5 to 7% of their overall position, and the company in question today, Marvell Technology, in fact this is one that sits right in the middle of the semiconductor value chain. They focus on the fabless designs, meaning they create the brains of the advanced hardware without actually owning the expensive factories themselves. So let's take a look at why Marvell could be a massive AI growth play today. Now they're a 70 billion plus semiconductor leader. They specialize in high performance chips that power data centers, cloud computing, and AI infrastructure. And unlike Intel or TSM, they don't manufacture the chips. They design them and partner with foundries like TSM to produce them at scale. And right now, their biggest growth driver is custom AI accelerators, specialized chips designed for hyperscalers like Google, Amazon, and Microsoft, who want alternatives to Nvidia's GPUs. Now, the market is expected to explode from just 3 billion today to over 20 billion by 2027, and they also play a key role in networking and connectivity, producing chips that move massive amounts of data quickly and securely, essential for AI workloads and cloud expansion. Now, with AI adoption ramping, management expects AI revenue alone to quadruple over the next 2 years, making Marvell one of the few pure-play beneficiaries of the semiconductor AI boom. So when insiders are quietly loading up on shares, it signals they believe Marvell's AI opportunity is just getting started, and they also announced days ago a 5 billion stock buyback program. Now this is a company that, as we will come to show you, has massively outperformed the S&P. They're up 775% in the last 10 years. They're currently trading around the mid to lower end of the 52-week range. In fact, last time we covered this company, we said this was a very strong buy, and it was trading around the $60 mark. It's now up nearly 50% from that point, where we get a double respectable buy rating from both Seeking Alpha and Wall Street. In fact, Wall Street 4.35, near the 4.5 to turn this into a strong buy rating. But we also want to let you know this one has been battered year to date, down 25%. They've lost 1/4 of their market cap in 2025. So let's take a closer look at Marvell Technology. And if we start from a valuation perspective, well, on a forward P, they're trading at 27, which is below the 5-year average of 35. So in isolation, just looking at this, it could be a potential undervaluation play. And then when we take a look at the blue tunnel, which as always for new viewers in particular, highlights within the parameters the expected or fair value, today we're seeing this below the bottom end, so a potential severe undervaluation play, something we've seen pretty much from March 2025. What we would also highlight, love to see this, intrinsically the price has been getting higher and higher, not something surprisingly we see with every single company. And if we were to zoom out to the last 5 years, we do get a bit of a roller coaster ride. Sometimes in fact the intrinsic price decreases, sometimes we get to see quite a sharp uphill movement. The only thing we would say though is with a company like Marvell, it does sit in the semiconductor space, which is notoriously very cyclical, and that is why when we come to other figures as well, you will see that show up throughout. And going a step further, looking at the last 10 years, we can see sometimes, in fact, very large stretches, the company has been trading at quite a hefty premium. As of today though, and for quite some time, we are seeing a potentially large discount. It's also one very similar to the likes of Nvidia and AMD, where the data center continues to climb at a very strong rate. If we take a look at the last 5 years, it's been growing compounded annually at a rate of 41% year on year, and in their most recent quarter with revenue up 58% in comparison to last year, the data segment alone is up 69%, really highlighting this is a very strong growth company We'll also take a look shortly at their future projections. And when we look at the makeup of their revenue, in fact, in the latest quarter, the largest portion, no surprises, is data center coming in at 1.5 billion, 69% increase from the same quarter last year, around 3%, so low single digit from the previous quarter. And whilst we do get to see quite strong growth in the other revenue streams, you can already see in terms of where it sits, we are talking very trivial in comparison to their data center overall. Now, their latest earnings, although will depend on which data sources you use, wasn't too dissimilar from what was expected, both on the EPS as well as the revenue. And whilst the company did drop quite significantly, 18% on the back of these results, they have recovered the vast majority of this drop. The thing that really hit this company was their forecast, and we say this time and time again, very important, as believe it or not, we're coming back into earnings season very soon, where companies, even if they beat extremely well, top line and EPS, if their forecasts are not at a bare minimum in line with analyst expectations, they will get hit. And that is what we did see in the latest quarter for Marvel Tech. They're estimating around 2 billion. Market wanted to see slightly higher at 2.11. Now, moving forwards into the next 4 quarters, they're expecting large double-digit growth to the earnings per share. Next quarter, in fact, 71%. Great to see over the last 4 quarters, whilst it has been fairly trivial, they have at a bare minimum either been in line or in fact marginal beat. And based on January 2027 earnings per share, forward P estimated to come down to 24.6. Now, in terms of growth, they get an A-. Last year, it was up 37%, well above the sector at 7% in comparison, above their own historical at 18%. Forward looking, they're expecting around 20% over the next 12 months. Again, a lot better than the sector, not too dissimilar from their own 5-year average. And when we get to the earnings per share, we're looking very strong over the next 3 to 5 years, 33% compounded annually, above again the sector at 15%, but also impressively above their historical 26%. And we can also note their free cash flow growth expected to be 45-46%, again significantly above the sector, but also impressively above what is a fairly high number for their own 5-year average at 41%, so it does look good across the board. And just diving into their latest investor presentation, their revenue overall was up 58%, 6% from the previous quarter. We got to see their operating margin up, something we love. As always, we talk about high quality companies increasing not just their top line, but also efficiency, so improvements to their margin. Not something we got to see on the gross margin side. In fact, it has slightly started to decrease, something we would say just to keep an eye on. Nice to note EPS moving in the right direction. And we would say, bear in mind their gross margin has been decreasing year on year, as well as slightly on a quarter by quarter basis, where their operating margin has actually shown the opposite. So whilst in fact perhaps the cost of these goods that they are selling is starting to increase, so affecting their revenue, or in fact the opposite, they're selling it for less while the cost is the same, we are noticing effect on the gross margin, but actually they're becoming very efficient. They're lowering their expenses, hence why we are seeing improvements to their operating margin. Bottom line net income, 120% increase from last year, 8% from the previous quarter. Likewise, EPS movement very, very strong. Data center, as we highlighted, also keeping up the pace, 69% from the previous year, only 3% from the previous quarter, and they also note here that they expect the next quarter revenue essentially to be flat, with top line revenue coming in at just over 2 billion. Now remember, we just heard analysts want to see 2.1, so it will be fascinating to note whether or not they can outperform. That will have a strong effect on their share price, although that's something they really need to beat. Now, we did say it is a cyclical company, and that will be shown in the numbers that we run through today. Free cash flow per share, as always, we want to see consistency to the growth. Not something we get for Marvel Tech, although a very large jump is anticipated over the next 12 months. Now, in terms of sales growth, you can clearly see here the cyclicality. Out of the last 10 years, 4 of them have been negative. 5% in 2025, large increase on a trailing 12 month, and you have to consider whether or not now the AI revolution that we are seeing is really going to be a massive, massive benefit to the company, and that will show up in the numbers moving forward. In terms of their sales, which we will get into a little bit more detail shortly, we do notice they have pretty much doubled over the last 10 years, although some years a bit of a decrease as highlighted above. And whilst they do pay a dividend, which is fairly trivial, they don't actually return excess cash through share buybacks. They actually diluted your position over the last 10 years. But as we highlighted at the beginning of the episode, they have just announced a very large 5 billion share buyback program. So that is great to see for investors and even those who are considering adding. Now, ROIC, as you know, one of our favorite metrics, ideally 10% or more, 12% for this specific industry. We haven't actually got this from Marvel Technology, so that is probably one thing we would say as a bit of a negative. Over the last 12 months, it does sit at the low single digit. Operating margin, in fact, also not something we like. Preferably consistency is what we want to see in the numbers, and above 16% for this industry. Most recent period coming in at 12%. Free cash flow, no worries whatsoever. Above 5% is what we get every single year, 21 on a trailing 12-month basis. And one of the most important metrics, in our opinion, is the net debt to EBITDA. Below 1.5 for the industry, numbers you see below, number of years it would take Marvel Tech to pay off all of their debt, net of cash on hand, and correlates to balance sheet strength. Now we get to see a decline from the peak in 2022, 1.27, good to see on a trailing 12-month, lower anticipated into the next year. So these are good signs. The balance sheet does, at least for the time being, and at a high level, look to be under control. We then move to what the institutions themselves are doing. They hold 84% ownership, selling 11 billion, we're talking in the last year. They bought around 50% more in the same time frame, 16 billion. They bought around 3 times as much, in fact more than that in the most recent quarter, the same in Q1 as well as Q4. And if you wanted the reverse of the trend, you would have to go to Q1 2024. More often than not, as we can clearly see, this is one institutions continue to buy, in fact net buyers every single quarter, and they continue to do so in 2025. Not only institutions, but as we highlighted, we did get insider buying, 3.3 million in fact over the last year, 2.11 in totality in the most recent quarter. And whilst we do see quite a lot of insider selling, one thing we would say, yes, insider buying we believe to be a bullish signal. Insider selling, not necessarily bearish, because management sell for many reasons, personal and financial. Now profitability, they get a B+, gross margin 50%, pretty much in line with the sector, little improvement to their historical figures. Now bottom line, on a trailing 12 month we get -1%, although we did just highlight on the most recent quarter and expected moving forwards, this is estimated to be positive, and we'll look at the income statement in a little bit more detail. Sector median sitting around 4%, and their own 5-year actually negative at 5.3. In terms of cash from operations, great to see at 1.8 billion, as that is an improvement from their 5-year average at 1.1 and well above the sector at 124 million. Now, as always, we like to compare their performance against others in the same sector and size. We've got NXP Semiconductors as well as some other well-known companies. Now, over the last year, they're up 15%. They are actually one of the better performing, as we can highlight here, whilst a lot of them have in fact been negative in this period. Over the last 5 years, they're also one of the better performing, up 114%. Not bad at all. We're talking more than a double if you'd invested 5 years ago today. And then when we zoom out to the last 10 years, they are the second best performing, 885%. That is incredible to see. But again, remember that past performance, just because they've done this well in the last 10 years, does not mean they will do the same moving forwards. We can see the best performing out of the bunch, MPWR, up more than 1,600%. Now if we do the same against the S&P and QQQ, in fact Marvel Tech pretty much in line with the S&P over the last 12 months, but they both have in fact underperformed the QQQ. Over the last 5 years, it gets a bit more interesting. It has outperformed the S&P, although marginally underperformed the QQQ. All three actually not too dissimilar from each other. And then when we zoom out to the last 10 years, we do get massive outperformance. Marvel Tech up 858, S&P only 240, much lower in comparison. QQQ also much lower at 506, but remember, it doesn't mean they'll be as strong moving forwards, but interesting to hear your thoughts whether or not you believe it is worth taking a look at historical data. Now, we said we want to talk about the income statement in just a little bit more detail. Typically, we like to see revenue growth, which is exactly what we get here and highlighted earlier. 2.6 billion, now in fact more than double at 5.8 in February 2025. Question is though, what does the bottom line net income say? We are talking about a cyclical industry, and do we get the consistency of the top line revenue growth? Answer in fact is no, we're not getting consistent increases over the last 10 years. In fact, they made a loss 10 years ago, $811 million. They've made near enough the same loss in the most recent accounts, $885 million. Definitely something to consider when looking at this company. On a trailing 12 month, also a loss to a much smaller degree at $103 million. These are things you do definitely need to incorporate, and perhaps something to add when we talk about our margin of safety. The other thing is a quick health check, total cash versus total debt, where it has dropped from $2.3 billion, now sitting at $1.2 in the latest quarter. But as always, one number here in pure isolation isn't going to give anything away, so we compare it to their total debt numerically and directionally, which actually cash has been decreasing, debt has been increasing, going from zero, now sitting at just under $5 billion. Now remember, we did look at the net debt to EBITDA sitting around the 1, in fact estimated in the next 12 months. So not too bad, but definitely something to think about. The thing we would say though is over the last few years, the total debt has pretty much remained flat. Now before we jump into our valuation, just to let you know, we have released our latest free weekly article. We drop one every single Monday morning to your inbox completely for free, covering severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of September. We are in fact dropping October's copy tomorrow, so make sure you're signed up. And we also talk about the estimation of what Wall Street see as upside over the next year. And you can grab a recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Now our intrinsic value gets to $96 derived from the discounted cash flow valuation. Now we have the growth rate moving forwards at 14%. Most recent year was an increase of 35. We just highlighted from Seeking Alpha, estimated to be around 45 moving forwards. So you could look at this as being conservative. As always though, we have a low, medium and high, 12, 14, 16. Numbers here are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Marvel or any others. Also worth flagging, based on a reverse DCF model, 11.5% is baked into the numbers. So interesting, if you believe it should be even lower, then it will signal to you overvaluation. If you believe this is too conservative, then severe undervaluation perhaps. So using the growth rate and the discount rate, we get the present value of future free cash flow terminal price, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, getting to $96, indicating 19% upside. We'll also show for transparency at 12%, $84, 4% upside, and at 16%, $109.35. As always though, we like to take through the middle rate, which is 14% today. We're not done because we apply a margin of safety. Remember, 10% is the minimum where we execute buy if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. In fact, we can already see baked into the price today is 15.4%. Some investors though will want more. At 20%, we would say a buy at $77. If you believe this, at 25 to be under consideration at $72. And if you want a bit more because it's a semiconductor cyclical industry, at 30%, $67. So let us know whether you see Marvel Tech with a 15% margin of safety a buy today. We notice Wall Street on average have a price target of $90 in the shorter term, indicating 11% upside. So in your view, insider buying, is it bullish? Does this now mean this is one for consideration, or do you see this as a hold or potentially an avoid? We can also flag, using the low rate at 12%, you are having a margin of safety, but much smaller at 3.7%. And if you're someone that believes we're being way too conservative at 16%, well, your margin of safety will be much, much larger at 25.5%. So let us know your views today on Marvel Technology and whether you want us to look at more companies where insiders are heavily buying. And don't forget, as always, to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.